Hi guys, I am VP. It is the second video in our One Upon Wall Street book show. In this video, we are going to see the part 1, that is preparing to invest. In this part 1, there are 5 chapters. Let us see it in a detailed way. Okay, let's get started. Okay, in the part 1, the first chapter is the making of the stock picker. In this chapter, Peter Lynch shares his experience of working as a fund manager in the Fidelity Magellan Fund, and he shared his experience. And he says that there is no heritage here required for an individual person to invest in a stock market. Rather than if he has a logical thinking, then he can invest in the stock market. It is the first point said by Peter Lynch. And the Peter Lynch says is the main mistake the small investors is doing, that is predicting the market. They are optimistic and pessimistic at the wrong time. That is what led to them into big losses. Okay. As well as Peter Lynch says that investing in a stock is an art, not a science. We cannot quantify investing, and all we want to know is basic knowledge to understand the business, and we should know some 11th, 12th grade accounting formulas. These are all the simple requirements we should have to invest in a stock market. This is what Peter Lynch says. Okay, when Peter Lynch about to take us the fund manager in the Fidelity Magellan Fund, the fund has $20 million in asset, and Ned Johnson advises him to not invest more than 100 stocks. But day by day, he increased his stock portfolio, and he mentioned that he could not resist buying a very good business at a bargain price, so that he kept on buying very different stocks. While his retirement, he almost having 1,400 stocks in his portfolio. And Peter Lynch doesn't advise us to do the same because the fund he has is so large, so that he does that. And Peter Lynch advises us to find a very good business at a bargain price. Okay. And Peter Lynch says that even though you find a very good business at a bargain price, don't invest all of your savings money in a single stock. That will lead you to a huge loss rather than diversify the portfolio. These are all the things mentioned by the Peter Lynch in the first chapter. The main thing is we don't need a financial background to be a stock picker and investor. And second one is all we need to have is a basic business understanding knowledge as well as some accounting knowledge. And the third one is to find a very good business at a bargain price, and we should invest in that. And we should not invest all our money in a single stock, rather than we should diversify our portfolio. Okay. And the second chapter is the Wall Street oxymorons. And in this chapter, Peter Lynch mentioned some of the common terms which is used in the Wall Street. They are street lag, inspected by four, some of like that. And before starting this chapter, Peter Lynch mentioned the John Templeton, who is a famous investor, and at 1970s he made a huge money by investing in across the countries. And as an individual investor, we should also look up to him according to Lynch. Okay. And now let's see what is a street lag. A street lag is nothing but a very good company, but the price is not increasing in the long term. It is because the Wall Street analysts and professionals may not find the stock interesting. That is why the stock price may not go up in a short time. But once we find a very good business at a bargain price, then we should invest in the stock, and we should wait until the price moves up. Okay. Peter Lynch says that as an individual person and an investor, we are having an edge over the Wall Street analyst. That is, we can work in the company or we can be a customer of the company, so that we can know about the company in and out while we are studying that, comparing with the Wall Street analyst because of our user experience. This is what the greatest edge we have according to Peter Lynch. Okay. And the second one is the inspected by four. In this saying, Peter Lynch explains that what are all the main four reasons the fund manager would ask for a business for not buying the stock. The reasons are: it was too small for me to buy, there was no track record, it was non-growth in industry, and unproven management. These are all the things which are looked by the fund managers in the Wall Street. As individual investor, we should also analyze these above things while we are going to invest in a stock. Okay. And Peter Lynch says that as a fund manager, the biggest worry he has is the amount of fund he is managing, because he has many restrictions while investing in stock. And as an individual investor, we don't have that much restriction, so that we can concentrate more in the business analysis. Okay. And like I've already said this before, that is, as an individual investor, we may come to know about some companies even before the Wall Street knows, because the company may selling their product near our neighborhood or in our street likewise, so that as a customer we can experience their product, and we can tend to invest in the company at the early stage itself. So that while the fund managers like Peter Lynch identifies the stock and invest their money in the stock, automatically the share price will go up and our investments also appreciate. This is a main advantage as an individual investor you and me have, Peter Lynch says. Okay. And the third chapter is it gambling or what? In this chapter, Peter Lynch mentioned about the risk factor while investing in a stock. The main two risks is: first one, we can lose all our money. The second one is we cannot grow our money. Okay. And Peter Lynch advises we should also park our sum of amount in the assets like bonds, so that to get a regular income and we can invest in the stock. Okay. And Peter Lynch says that if we buy a wrong stock over the wrong time, then our investment even couldn't beat the savings account in the long run. So that while we are investing in stock, we should be very careful about their future growth also. This is what mentioned by the Peter Lynch in this chapter. Okay, the fourth chapter is the passing the mirror test. Before we start our investment in stocks, the main three things we should have is whether we have a house, the second one whether we need the money in the short term, and the third one is whether we have the qualities to invest in the stock. The Peter Lynch saying goes like, before you buy a share of anything, there are three personal issues that ought to be addressed. The first one, do I own a house? Do I need the money? And do I have the personal qualities that will bring me success in the stocks? Whether stocks makes a good or bad investments depend depends more on our responses to their three questions than anything you have read in the Wall Street Journal. Okay, these are all the three important questions we should ask ourselves before investing in stocks. And in this chapter, Peter Lynch explained the importance of these three things: the house and the short-term money we needed and the quality of ours. Adding upon to it, Peter Lynch says that whatever money we are going to invest in the stock market, the money for us should be a afford to lose money. The quote goes like, only invest what you could afford to lose, without that loss having any effect on daily life in the foreseeing future. Okay, if we made a loss in the stock market, then that should not affect our day-to-day life. It is the main point Peter Lynch mentioned in this chapter, the mirror passing test. Okay, the chapter 5 is, it is a good market or not. Please don't ask that. Why? Because by already asking this question, you are making yourself to timing the market. That is impossible. Okay, please don't ask whether the market is good or bad. All you need to have is a perfect plan to invest your money. The first one is to find a very good business, and second one is whatever money you are investing, it should be a afford to lose money, and third one is we should buy the company at a bargain price. Okay, these are all the small principles we should follow while investing in the stock market. And as an individual investor, we should never try to timing the market. Okay, and Peter Lynch advises us to not to worry about the market. If you want to worry about something, then worry about the earnings of the company which you are investing. Okay, that's what's matter. Okay, and Peter Lynch says that pick the right stock and the market will take care of itself. These are all the small principles mentioned by the Peter Lynch in this chapter. And Peter Lynch mentioned some of the points you should remember after reading this chapter. And the points to remember are: don't overestimate the skill and wisdom of a professionals. Okay, take advantages of what you already know. Look for opportunities that haven't yet been discovered and certified by Wall Street companies that are off the radar scope. And invest in house before invest in stock. Invest in companies, not in stock market. And ignore short-term fluctuations. Large profits can be made in common stocks. Large losses can be made in common stocks. Predicting the economy is futile, that is having no success. And predicting the short-term direction of the stock market is also futile, that is useless. The long-term returns from the stocks are both relatively predictable and also far superior to the long-term returns from the bonds. Keep up with the company in which you own a stock is like playing a endless poker hand. Common stocks are in for everyone, not even for all phases of personal life. The average person is exposed to interesting local companies and products years before the professionals. Having an edge will help you make more money in stocks. In stock market, one in hand is worth 10 in the bushes. Okay, these are all the points we should remember after studying the first part, that is preparing to invest according to Peter Lynch. Okay, in next video we can see about the part 2, that is picking the right stock. Till then, stay tuned. Thank you for watching.